is March 11th?
Yeah, before that class, let me check. It's the 11th. Let me double check. Okay. Yes. So that means, yeah, today, you know what happened? We finished very fast. Today we'll finish chapter 6. I'm not rushing, okay? Remember, if I couldn't finish the next week, then we will be pushed to 18. So far it's 16. You will see we will finish today, just a couple of slides, chapter 6, then we touch chapter 7. The next week we have nothing to do. We just chapter 7, right? So then, yeah, 11 going to review. 16 will be exam. 16, okay, in the class hour. I will make an announcement when we settle. Yeah. Let's see what
thank you.
You're welcome. Let's see what we do today. If we can do schedule, see the ahead of time now, okay? So we did talk about this ratings, okay? When you talk about bond markets, of course have always ratings because they, first of all, they will be, you go to the rating agency, right? So like here showing you Moody's, Standard Poor's, and Fitch, right? So they have the, you have, if you want to sell in a bond, your corporation want to sell in bond, you need to first go to the rating agency, okay? They will help you make the ratings. Once they make a label you, so basically research, okay, research on your company. So your company management, your company cash flow, company, the revenues, everything, a profit, earning, everything. And then you figure out, say, compare your peer, your company doing well, and your AAA, AA, very, very important. Because this rating reflects your yield. Remember the yield to maturity? That reflect that yield. So then becoming, if you high quality bond, your company, your AAA, then compare compare your competitor to BBB, you will be charged a lower yield. So that's if you're raising capital, issue the new bonds, you will pay lower interest rate compared to your competitor because your rating is good. Okay, so that's why rating is very, very important for corporations because cost them borrowing less if you have high ratings. You have lower ratings, it costs you more. You have to pay a lot of coupons or high yields. You can raise in this capital, but you need the money. So that's why you have to raise in capital. So that's the rating is. It's in bond market is very, very important, okay? Because that's the only information we have it as public information there, okay? So risk structure of interest rate. Remember we mentioned time structure, the yield, term structure, interest rate, the yield curve. Now risk based on different maturity, different liquidity level, they have risk too. Okay, like we said, long-term bond versus a short-term bond. Short-term bond, of course, we refer to same name. Okay, same name means refer to same issuer. For example, referring to same name is GE. Next bond is the same name as GM. All the GM's 2-year bond was a 10-year bond. It's the same name. Then 2-year bond relatively liquid, then 10-year bond. That's what I mean, okay? So you refer to same name. You cannot compare to different name, like different maturity. Then you're not, like we say, we're not in the same benchmark, how we compare. We cannot compare. So that's what, okay? So liquidity, the same logic that way, okay? So liquidity. Remember we mentioned this before. We said liquidity is how fast, okay? And it can selling at the fair value. Okay, so that's here trying to say relative ease means easy to selling or difficult to sell, right? So which assets can be converted to cash. It means you all is just want a cash. You want to convert to cash. You're selling house, you're selling stock, all purpose want to get the cash. So how quickly you can get the cash. But you also don't want discount the selling, get the cash. You lose the value and selling, get the cash. That's fire, we call fire selling, means like this is really not a fair value selling. It's not called liquidity. Everything discount can selling faster, right? If your house, $1 million house is selling 200K, selling very fast. But that's not called liquidity. That's liquidity means fair value, means in the benchmark fair value, then you're selling quickly. That means this product is liquid, okay? And then people prefer liquid product, okay? So that's what I mean. Okay, so cost of selling bonds. If a bond, if not liquid, you take time. So that's one thing is, and also like we remember somebody of maybe you already mentioned about that when you're selling a bid and ask spread, this spread will measure the bound of the liquidity. Means if wider there's a spread, bid and ask. Okay, so when this wider this spread means this bond now liquid. It means not that many people are buying or selling. It's just like I say, it's name is very, very important. Apple stock is popular, but Apple bond also popular. So globally trading, playing, all use those name playing Google, Apple, Amazon, those one. So their spread very, very narrow, and that's why its liquidity compared to no brand name, then this liquidity will be higher. So it means good, relatively easy to sell. For example, let's say you have Apple's bonds you want to selling. If you want to convert it to money, you pretty much relatively easy. But compared to if let's say hypothetically you have a GE bond, you want to sell it, you maybe had to sell it in a fair price, you had to wait. You still cannot get the cash, but you need the cash. So then what? You have to say, you know what? I'm selling at a discount lower. I just limited order. You're just selling order lower price, so you can get rid of it. So get the cash. So that's what is no liquidity hurting you. If you desperately need cash, that means you have to sell it at lose money, right? You buy at a 100 par, but then you have to sell it at a lower than 100 in order to get the cash. Okay, that's what liquidity is very important when you need a money moment. Okay. So for bond market, even more, because bond market normally, if it's not treasury securities, then become corporate bond, municipal bond, all kind of those bonds have default risk. So also based on say, good quality of muni or good quality of the corporate bond. Like I said, becoming name brand names becoming important. So then easy to selling. Okay. So that's why they're trying to tell you liquidity is number. Even more people, like I said, Apple and Amazon's, Google's, more people buy, selling, trading, those hedging, a lot of things. So then will be, more volumes, more number of people buy, selling, more liquid. If you don't, you just less liquid. And then you can see from the bond, the bid and ask spread wider. That means no liquidity. Okay, so that's pretty much tell you bond liquidity is very, very important. That means you think your bond worth 1,000, but actually cannot sell it at 1,000. You maybe can sell it at 900. You think you have 1,000, but you don't. Because you only at the moment when you get the cash in, you know how much you can sell. Okay, so you normally will buy liquidity assets. Okay. Now next one is income tax consideration. So remember, you buy coupon bond, you will get a coupon. You're going to get a coupon payment every year or semi-annual every 6 months. This is a coupon income. So those income for you, when you collected this income, you're going to pay income tax. Okay. So many people, like we did the exercise, rich people normally will pay, high taxes. So they will consider where I can get rid of the tax. So they will buy something like a municipal bond. So then will be get, pay a little bit less tax, only federal tax, nothing else. They're going to pay something like that way. So income tax is a consideration. People invest will consider income tax. So that's the one thing they tell you here, okay? So then you buy the municipal bond will be less, like we did that exercise before, okay? So this one, same logic like before, okay, follow what we did. We did a very good job last time, okay? So this time do the same thing. So if interest rates on municipal and treasury bond reaction, okay? So here trying to tell you, if we know this muni, okay, muni market bond, okay, muni bond demand and supply already in the equilibrium, okay, in the blue one, okay, so suddenly we know our policy changed, means the tax will be increased. Okay, so if we know tax increase, like right now, we all anticipate we're going to increase tax. So what happened to muni? And remember, the money going to be had to put somewhere, then put where. See that whether you can get it in this chart. So if we know, let's say, we know right now the Biden want to increase tax no matter what. Okay, so So if you increase tax, what happened to municipal market?
Demand goes up.
Demand of muni will going up, right?
Yes.
Very good. Yes. So you can see the demand curve shift to right. So if the demand curve shift to right, so demand going up, right? So because people want a muni, because we know tax increase. So you can see here that municipal bond price is going up from P1 to P2. Okay, because we know this muni going to be favor right now. Everybody wanted it. So if price of a muni going up, what happened to interest rate of the muni, yield to muni?
It goes down.
It's going down. Very good. So then you can see the muni market will be hot. People want to buy in on municipal bond, and then municipal yields going down. Okay. So like I say, is people buy the muni. People, like I say, it's $1 billion go to this market. So where the market money coming from? You see here in this case, use treasury bond as example. Okay, so in the beginning, treasury market is in the demand and the supply. Okay, so in the equilibrium. But once we know the tax going to increase, and then people will be selling treasury bond. So demand for treasury bond will shift to where?
Left.
Shift to left. Yes, very good. Shift left. So when we shift left, see, so then so the equilibrium, new equilibrium going here, right? So going down. So treasury bond price will down. Okay, dropped. Okay. So treasury yield will going up. Okay. So this just give you respond of tax increase. What happened to these two market? One is municipal market, one is treasury market. Okay, so people selling the treasury bond, use that money go buy the municipal bond. So that's why you can see due to tax changed. Okay, so that's how we can figure out the tax effect to the market. Okay. So, okay, now we're going to go to the term structure of interest rate. I mentioned that. Remember the curve, the yield curve. Now today, from here going forward, it's going to be difficult because you're going to sleep. It's very difficult now. Okay, we'll see. Let me try to draw this again. Remind you what's the term structure interest rate. Okay, remember I say is this is the horizontal line and it's vertical. Okay. And the yield curve will be like this, upward, could be downward too. Okay, so why I say term is because this is a term. What's the maturity? 3 months, 5 years, 10 years, 30 years. So each maturity have different level yield, just like you saw in the Wall Street Journal market data, and then you can see the yield curve. Okay, I cannot open for you. I cannot because the June didn't, if I open that, it didn't open up. So, okay. So that means this is whole thing is called term structure of interest. Why structure? Because this is 3 months yield. Okay. Okay, let's say this is 1 year. So this term, okay, different term have different level yield. Okay. And this is 30 years. So we have 30 years market bond with auctions. Then we will know what's price we can sell. Then we will know what's the yield right now. So that's how this is yield, this yield curve. Okay. This is called term structure of interest rate. So like I say, if we get a coupon payment, you get a cash payment should be based on this interest rate. Okay. But when we calculate a bond, we use one constant yield. We use this one. Flat one, okay, flat. I cannot draw the flat one, okay? It's a flat, let me do this way. It's a flat one. It's a flat one. So that means it's calculated, okay, based on bond price. Remember, so this one is year to maturity. This yield to year to maturity. But this is really in the real world yield curve. This one you don't observe it, okay? This we calculate it based on bond price, and that's why I call year to maturity, assuming you're holding the yield. Bond to mature. Okay, so that's the term structure. Okay, so bond with identical risk. Identical risk means same name of the bond. Okay, for example, you cannot say GE, GM. You cannot say normally they are not identical. They are not the same. Of course, same name will be identical risk. For example, GE is bond 10 years versus GE is 5 years. If GE default, it doesn't matter 5 years, 10 years, they all default. okay? Because GE name just default, right? Bankruptcy. So that's what I mean, identical risk. Same name, of course, identical risk. So bond with identical risk. So let me go back here. It's important here, okay? So for example, I draw this treasury T bond, right? So if I draw another one, so this is GE bond. See, different bond, different level of yield, okay? Let me say I draw this one, let's say this is GM, okay, General Motor. So I'm properly drawing the different shape even. So each name have different, but if for the same name, for example, GE bond this one and GE bond this one, same risk. What do you mean same risk? Same default risk, okay? Because identical, same name, same company, okay? So that's what I mean, all right? So that's term structure. So this term structure we showing that I show you many one, right? GE, GM, and the Treasury. So each one have their own yield curve. Each one they have their own term structure interest rate, right? So bond with identical risk, liquidity, like I say, is like we just talk about how soon, how quick the selling it, right? So each bond the name have different kind of liquidity, like GE versus Treasury. Of course, it's Treasury much liquid, right? And the tax character. So like I said, if the other bond yield curve is the muni, and there will be tax in there too, right? Tax characters. So all those in, right, with identical, those may have different interest rate because time remaining, right? You see, that's exactly what I said. Let me repeat again, okay? So bonds with identical risk, liquidity, and the tax characters may have a different interest rate because time remaining to maturity different. So they're trying to say, even though everything else is the same, but still have the difference of interest rate, like I saw the curve, GE, right? Same liquid, everything, maybe still different interest rate level. This one is higher than this one because different term, different maturity. So that's why interest level, interest difference, like this one interest rate different from this one because the maturity different. That's trying to say even the same name because the same name, same rates, same everything, liquidity, everything else, okay? Then the only thing left, it is the term. So that means still can be different interest rate because the timing different. So 5 years versus 2 year different. That's what it's trying to say, okay? That's the term structure of interest rate. Okay, so I just showing that in the yield curve, right? You can see they tell you plot of the year on bond with different term to maturity, right? I just did it. But the same risk, like I said, same name, same risk. Apple is Apple name, GM name. So you can see different. So even though with the same name means the same yield curve on the line, liquidity tax, but still can have a different maturity. That's what is yield curve, okay? However, yield curve is looking at can be upward sloping. I just showing you the upward way, okay? Can be flat, can be inverted. This is a very important piece. Let me draw this again. So what did I say is, if you look at the real world, they do have this way, okay? You can see yield curve can be anywhere, okay? Can be upward. This is normal one, okay? Upward. Can be flat, can be like this, okay? Can be inverted. Yield curve can be like this, all right? So that's what we're going to learn. Why like this, right? So here's, okay, so can be, so long-term rate higher, like I say, is all the same. So inverted long-term rate are lower, so that means short-term is higher, okay, like I draw the line. So why could it be happen like that? I will talk there very soon, okay? So here's what did they tell you? The facts that the theory, we're going to use the interest rate, those theory to interpret why yield curve like that. But before we go to there, interpret it, okay? Let me ask you common sense question, okay? Let me ask you a question. Imagine, okay, just imagine right now, just think of what I say. Imagine you are the CEO in the commercial bank, JP Morgan, okay, you're working there as CEO, okay? Remember, commercial bank, the main job, it is take the deposit money and lending out. That's commercial bank, the majority of business, right? Of course, they have other. We don't talk about global bank have many other piece of a department. We just said mainly their core job business is the lending business. So they take your money. I'm just exaggerate, make it very big, right? So let's say right now yield curve is inverted. So 3 months yield give you this here. Okay, let's say equal to hypothetical. Okay, pay you to say 5%, just to make it you feel bigger. Okay, so 3 months in the market in the JP Morgan, they offer you 3 months is 5%. Okay, so then let's say you borrow student loan, hypothetical. Okay, borrow student loans 4 years here, interest rate is 2%. Okay, so remember, just hypothetical thinking, you deposit money 3 months CD, whatever, or just say hypothetical, you put it in your checking account, interest rate gave you higher. Remember, who pay you interest rate in here? You deposit money, who pay you? Bank pay you. Very good.
The bank. Yeah.
So bank pay you 5%, okay? And then lending your bank, lending your classmate, student loan, lending out, who get the money over 2%?
The student, the person who took out the loan.
Student pay 2%, right? The banking get the loan.
Yes.
But yeah, very good. So tell me, what's the bank have it? What's the net result of the bank?
-3%.
Thank you very much, because this is very important. Okay, because the 5%, 5% it is banking paying you, because you put a deposit there. Okay, they banking paying you. I'm thinking, like I said, you're CEO, so you had to pay out a 5%, and then you're lending out the loan, the 4-year loan right now is 2%. Sorry. 2%, because it's come in for banking, it's come in 2% in, because lending your loan, then they got the money in, so 2%. All right, 2%. So net result, you're a CEO. Remember what I say? You are right now do this business right now. You're lending out, only make it 2%. But however, deposit in your account, in your banking account there, because that's not your fault. It is the market, the yield curve like this way. So therefore, deposit interest is higher, short-term interest is higher than long-term rate. That's what inverted. So banking right now have negative profit. So how come banking can survive? If a banking, let's say hypothetical, make life so simple. This is banking have no other business, only do loan lending business. Take your money lending out. Can they survive?
No.
No, exactly. That's why banking bankrupt, okay? So whole point is that's why when yield curve inverted, when like that, this is inverted, okay, I'm exaggerated, but normally it is inverted, it's hurting banking. And that's why banking stock not going up. Did you see right now banking stock price going up right now? Because right now yield curve will go to steeper. We have been inverted for a long time. Now we finally, because the Fed keep make this lower, shorter end, keep lower, and this one going steeper over the time. So right now, banking stock doing well, because we all know, even you see the market tank, we all know the long end of the yields right now going upward right now. So it's favor to the bank. You see why favor the bank? Because this inverted hurting. Okay, banking, but steeping is good for the bank. That's why this whole scenario showing you about yield curve so important, and banking why sometimes it's hurting, sometimes it's a good deal for banking. Okay, so that's the interest rate. Okay, so now we go now. So we want to do the theory. Okay, very soon we'll go there. So interest rate on bonds of different maturity moving together. Remember you saw it before. You even see it, right? So you can see they're moving together. Although we know who is up or who is in the bottom, we know that the reason. So now we also see the chart, the trending, they all trending together. So that's what we know. This is a fact that we saw it. Okay, so let's see other fact. So interest rate moving together, we know. So now when short-term interest rate are lower, yield curve are more likely to have an upward sloping. So because like I say, it's go back this chart. So that's what the Fed is doing, okay? When this one, the short-term interest rate going lower, the yield curve will incline to be upward. Of course, because this one is lower, everything is follow it. So then relatively the long term will be higher, because if this one very low, like we are zero, so the long term, even zero, we're like this, but we're still upward, okay? To tell you, say normally, if the short term lower, then long term will be a little bit upward. So that means steeper. That's what the Fed is doing actually, okay? But when short term rates are higher, the yield curve are more likely to slope downward, so inverted. When the short term rate higher, just like we did the example, okay? So yield curve almost always slope upward. So in normal time should be upward. So it means normal situation should be, it's not like a banking. Remember, this happen all the time. This happen, okay? But normal time is upward. That's the normal situation. So which is normal, we are in the banking situation is a little bit healthy situation, okay? So that's what we did. So that's the fact. Now we're going to go to theory, okay? So how are we going to interpret the yield curve and interest rate, how that works, why like that? So we have 3 theories to explaining about yield curve. Why we need 3? So we just saw the facts. So why we need 3? Because no single one can be the best to capture all those facts. So we have to use the different theory to interpret why yield curve like that. For example, why yield curve inverted, why yield curve upward, why flat. So that means we have to use 3 theory to interpret, okay? So we go there. So one is expectation theory, okay? We're going to explain about those facts. So they're trying to say, explaining which one, okay? And then we use a second market, segmented market, okay? So let's see how that theory interpreted. The last one is liquidity theory, okay? So there's 3 theory trying to capture why interest rate moving together, why yield curve upward, and why, you know, those some interest rates higher than the other one. Okay, let's see. First theory. So expectation theory, okay? So that means, of course, expectation. But follow me, okay? Like I said, when we talk about theory, it's boring, okay? But however, if you follow me, you will see what that mean, why we like that way, okay? So this is theory. So interest rate on long-term bond will equal an average. So this is theory tell you, okay? We will do the example, okay? Just so I just tell you this as well. So I don't want to read this for you anymore, okay? Just directly go to example. So this is theory trying to say it's the average of a short term and plus right? So I want to say those things. I just go here right away. So this is theory. Give example. Then you will understand what the theory trying to say. Okay. So let's do the example. So expectation theory trying to say, give example. Say if the current 1-year bond yield, okay, current rate, 1-year interest rate is 6%. Remember, interest rate right now, looking at the interest rate, all by default is a 1-year rate, okay? So 6% right now. But you expected interest rate on a 1-year bond, just this 1-year bond, going to be 8% next year. Just like we say, okay, if right now interest rate is 6%, then you expected the next year interest rate, this 1-year rate, okay? We all refer by default 1 year to per annual, right? It's 8%. So from 6% to 8%, 8% you expected it. Right now, still right now 6%, okay? So expectation theory say, okay, if based on your expectation, then the expected return for buying 2-year, 1-year bond, okay? So I will show you what's going on, okay? Average rate gonna be this one. I will show you what's going on, but I do a calculation first. So 1-year rate, this year interest rate, plus next year 1-year rate, then do the average calculation, say 7%. So that means next year, so that's what the 7% is next to, from now to next 2-year rate is 7%, okay? Now, let me show you what that means, okay? Okay. Okay, so you have 1 year rate 6% right now. We know, we see it in the market, okay? And the 8% we expect it. Means we do not know, we expect it, okay? But based on the theory, it's trying to say is this year's interest rate, we see it. So from the market, okay? We saw it right now. And then your expectation one, you expect it going up, this one, add it together, you do the average equal to 7%. And what's this interest rate? This interest rate is a 1 year annual rate, but for 2-year period. What I mean? Okay, let me show you again. So this is the, remember we say interest rate, and then like it's this one, okay? So what I mean is you saw 1 year rate, for example, here, 6%, okay? And then remember I say this rate is a 2-year, one period, okay? So 2-year rate. So how we figure out this rate is based on the theory equal to 7. So this one is 6%, all right? 6%. And this one is 7%. Okay, remember 7% is also per year, per annual, but it's 2 year in the market. You're watching in the market year curve. This year, remember I just showed you said 3 months, 1 year, and this is 5 year. 5 year, this interest let's say equal to 8%, but still per year, per annual, 1 year rate, but a 5-year maturity. Same thing, this one 7% is 2-year maturity, but it is per year, give you 7%. You understand what I'm saying? Per year, okay? So per annual. So this is per annual, this is 1 year rate, and this is a 2-year rate, but it's a 1 year per year, per annual, your average interest rate per annual, okay? So how we got this one, we figure out, we use the calculation. How we calculated it? Because we saw right now, 6% is right now, we see it. So this we know. But this one is we expected, we do not know. We think could be 8% because we think inflation could be there, okay? So today you see next year's 1 year rate, you expect it's gonna 8%. So therefore, when we calculate, we got this rate is 7%. That's what I mean, okay? Ask me a question if you get lost here, okay? So that's what I mean about this expectation theory, just like right now. Remember we said, oh, we're going to have inflation, interest rate going up. Actually, the market already pricing in interest going up, right? You see today also another difficult days. So that's pricing in already. Just that's what we expected. We do not know. We expected. And that's how this theory interpreted this way, okay? So that's how we got 7%. You okay so far? So that's easy for you. If you know, you just, this is theory, trying to price in, use average that way, okay? So if we use this node, use label, we're trying to do the formula, okay? So if you invest $1, so follow me here, difficult, okay? So if you invest $1, just $1 right now, okay? Today interest rate is IT today, okay? So T time T. Next interest rate, T+1 means next period interest rate, okay? Just like I said, today you see next 1 year rate, which is the next 1 year period, right? So that's the 8% in our example. That's another example. So 2T is, remember I said 2 year period, 2 period bond. So remember I said 2 year maturity bond, that's a 2 period, so that's 2T, 2 year maturity. But also it's 1 year rate, right? You remember interest rate always per annual. Every year was the pay yield, so they pay 2 years. So each year pay 7% for 2 years, 7 and 7, all right? But it's 2 year maturity, right? It's a 2 year period. That's how we give you this note, okay? Then we analyze it, follow me, okay? Like I say, if we follow easy. Okay, you invest $1, right? So let's see. If you invest $1, so then if you invest 2 years, okay, remember you buy 2 year maturity, for example, bond, so 1 year and 2 year, okay? So let's say this is 2 year maturity one. So 7%, for example, right now, 1 year over 6%, then 2 year per year over 7%, but for 2 years, okay? So you can see your first year return, $1 multiplied, this is your first year return, you okay? So $1 multiply 1 plus your interest rate, for example, 7%. And then you do not take money out. You continue invest another year, so 7%, remember? So invest again. So this is your total, your return. You invest $1 consecutive 2 years, okay? Because you use 2-year maturity, that interest rate, for example, 7%. 2 years, then minus $1 your principal. The rest is your net gain, right? So now this formula, just follow me, okay? This formula, you open up, you're okay on the open up, right? You agree? Then after you open up, you cancel out the 1 and you become this formula. So far from here to here, you okay with me? Are you
Professor,
okay?
how do
Yes.
you get the -1? Where does that come from? Is
Okay,
that just part of the
it's a
formula?
principal. It's a
Okay,
principal.
just minus principal. Okay.
Yeah, because your money is $1, right? So $1 here, you don't see it. Multiply, you invest. Yeah, -1 is your principal. Okay. So here trying to make life easy. That's why they try to do this way. But because they trying to think, you never learn, how to solving deeper of mathematics and make it this one. But that's okay. This is easy for us to understand. Okay. Now, because we're talking about the interest rate, so therefore this power, 2 power, you will do the calculation, you will figure out. So interest rate, if 2 power, this term is very, very small. If you're curious, think about it, let's say 2% interest rate. When you get 2 power, what's this gonna be? Very, very small, right? You agree? Because this is small, we cancel this out. We don't ignore it. So not big deal. So we ignore it. So we drop this term, okay? So that means equal to 2 IT, means what? Equal to 2 multiply the 2-year maturity 1-year rate. You understand that this bond is 2 years. Remember yield curve? Let me start again. So that's why,
Professor?
Yeah, go ahead.
Why is that part dropped? The
Because
part
it's
that's very
small. Because small. For example, let's do the example. Okay, let's do you guys do it. Let's say interest rate is 2%. Okay. So you tell me about 2% of this interest rate, 2 power. Give me this result. Equal to what? Equal to 0.0004. You agree? Yes or no?
Yes.
Yes. So this is too small. So we say for life easy, so we drop that one, okay? But also I want to mention about that's why we want to say the yield curve. You can see want to mention again this piece, okay? This important piece. Remember, see, let's keep mentioning about this curve. So this piece, here's a different maturity. If this is 2-year material, this is 2 year here. This is 2-year maturity, okay? And this is 1-year maturity, okay? So what do we got? This one, 1 year that one we see is 6%. We saw it right now in the market, but this one we do not see it next year, 1 year with interest rate, we do not see it, but we do not see it, we do not know. But we do expect it here, put 8% here. I'll put it here, 8%, okay? So we do expect next year, this year, this is 6% is 1 year rate, okay? 8% also 1 year rate, but we do not know, we expect it. But however, today we see 2-year maturity rate right now based on expectation theory, say should be equal to 7%. So that means this one is we see during this 1 year, right now we see this 2 years maturity. Remember, and this is 5 years maturity, means a 5-year period you invest in that interest rate, in this interest rate, okay? And this one is a 2-year invest in this interest rate. So 1 year 7%, next year also 7%. So this one is I2. This one is I2T, okay? This one I2T. Of course, this is difficult to type in here. I2T, okay, just assuming that one, okay? But this one is IT. This one just I1T. I just T. Okay, so just for now, because you will be feel difficult here, just I cannot type in that way. Okay, now follow me. Okay, so we got this piece. Let me repeat again. Okay, you invest $1. Okay, you know what? I have to go back there again. Okay, I do different drawing. Okay, so here is Let me join here, okay? Okay, so here, all right. So 1 year, okay, 2 year, okay. So you invest $1 in the beginning here, $1, $1, okay? You invest $1. So this $1 at the end of 1 year will be equal to $1 multiply 1 plus interest rate, I. Okay, so that's this I remember just I to T that one, I just drop that one for now, okay, for you to see it. So I'm now taking money out. So I want to invest to another year. So leave this is my money, leave the bank for another year. So multiply 1 plus I, okay? So this is the end. So after these 2 years, right? So that's all my money. But if I subtract 1, mean my principal, remember? Then that becoming my net, all the net money is my interest, okay? What I earn. So you open up this one, you will be coming this formula, okay? Like this one. But then when we open up, we said, okay, just did, okay? So this one, this term, no matter how big interest rate, still percentages. So this is too small, we can ignore it to make life easy. So that means now our investment in 2 year consecutive, then we will be end up with interest rate is 2 multiply this 2 years annual rate, okay? So, okay, we leave it there for now. We go next one. So that's what we did, similar like we just did now, okay? So we do 1 year investment. So put $1 invested, just put a 1 year interest rate, like our case is 6%, okay? Then we leave money there, but we invest another 1 year, which this time is we do not know is expectation interest rate. Remember what I said, okay? Before we invest is 2 years maturity rate per year. This one is invest 1 year rate, okay? And then next rate is we do not know. In our case, it's 8%. We expect 8%. So we invest $1, so earn 6% that one, and then 8%, okay, expected. Then same thing again, subtract our principal. We don't, the net result is our interest of what we earn, okay? So open up, and then 1 cancel it. So we leave this term, okay? So after this, what do we say? Same thing, okay, calculate this one, 6% and multiply 8%. This is also relatively very small compared to others, okay? Small, you do the math. So 6% multiply 8%, so what? 4.8%, no, 0.0. Let's go there, calculate it. You do the math for me. Okay, so 6%, tell me this is small, not small. 6% multiply 8%. So give me the result. So 0.000. You agree? You agree? Yes. So $1, so you can see, don't even 1 cent, right? So too small. So we can ignore it. So now you're happy, we can ignore it. Just make life easy. Okay, when we ignore this piece, so then we equal, so then left is 1 year interest rate plus the expectation of interest rate, so 8%, okay? Now what we say is they must be equal. Means this 2 years, 1 year rates should be equal. What do I mean? Okay, let me go back again. What do we draw the chart there? See watching. What do we say? We say is, okay, this is 6% we saw it today, okay? And then here's 8%, we expected 8%, okay? Okay, so what do we say is that, okay, you invest $1, multiply earning 1 year, 1 plus 6%. I'm right now using numerical, make life easy. And then I'm leaving there, but this is my money, earn 1 year. Then I will be right now, I will be invest rest money for next 1 year period. So 1 plus, I expect, okay, I expect 8%, so I put there 8%. So what I do in this one should be equal to, I invest $1 and I invest 2 year consecutive, not 1 year by 1 year again, just 2 year. So 2-year period, but each year give me 7%. Okay, now I do not remember 7% is 2-year maturity, but for 1 year, each year, so 1 plus 7%. Okay, they must be equal. If not equal, you can do in the long run, you learn things, you can do arbitrage, long, short, certain things, all right? They should be equal. So let me repeat again, okay? Difficult is here. This one is 2 year. Remember I said, you see the yield curve? This is the yield. So 2-year maturity one, but each year 7%, okay, in here. This 8 is 1 year, next also 1. This is 1 year, 6%. And you expect next 1 year. You didn't expect next 2 year, okay, 1 year. So that's why it's also 1 year. So that's why you use your observed the 1 year rate and you expected the next year 1 year rate, okay? This one is 2-year interest rate in 1 year and next year. So what do we say? We said they must be equal. They have to be equal. Okay, even not this is what expectation theory argument. Even they're not equal, you're gonna arbitrage. You have to go back to equal. So therefore, the equal. So therefore, you go back here, the equal now. All right, so the equal.
Professor,
Yeah, go ahead.
so the 6% is year one. The
1 year
8%
rate, 1 year rate. 8% also 1 year rate. Yeah.
is 1 year rate. And
Yeah.
okay, so the 6% is the 1 year rate in year
Right.
one.
Yes.
And the 8% is the expected 1 year rate in year two.
Yes. Your next
Okay, and-
year, 1 year rate. Next
Okay.
year to traveling, right? So let's say after passing next year, the 8%, just like a 6 year, that one is a 1 year rate, right?
Okay, yeah. Mhm.
Yeah, right. You got it. Very good. Because this when you're going to learn forward, you're going to be lost. Yes. So that's it. Today we saw in the market this 6%. We see 1 year rate 6%. Okay. So then today you assuming your timing passing. Okay. 1 year later, imagine, close your eye. Imagine 1 year later. 1 year later, next 1 year later, that moment you see 1 year rate is 8%. That's what it, but you do not know. So now we're assuming, but by then when we've been there, it's 8%.
Oh, Professor, is it the same
Yeah.
thing for 5, 10, and 30 years?
Yes,
just get
same
that
thing. That's a
average?
forward rate. Yeah, that's a forward rate.
Right.
Yeah, we're going to do that. We're going to do that. We're going to do it very soon there. Yes, the same thing. But the only thing is time traveling, you need to imagine. That's what I keep rolling there about 8%, 7%, because different story. The 7% is 2-year maturity, right? Just like today, you go to market, you see 1 year interest rate maturity, treasury bond selling how much yield, and then 2 years selling how much yield, right? So in our case, 2 years is 7%, and 1 year 6%, right? So the theory trying to say how we got 7%, okay? In this expectation theory, that's how we know this is market trading at 7%. Okay, so first of all, so now we know the equal, the argument there. So now we're done. So that means 2 years, that's 1 year interest rate. This is 7%, right? So that interest rate equal to 1 year interest rate plus next year 1 year interest rate expectation. Okay. So you can keep going on, just like I said, N years, right? So N year interest rate, like a 30-year interest rate right now offer 1.8%, 1.8%. How we know that? Is should be get it from there, from here. So that means we know 1 year rate, and plus we expected 1 year rate, that moment was that interest rate, okay? After that, then we expected that after 1 year later, then what's next expectation 1 year rate? Or expect the short-term interest rate, but let's say it's 10 years later, 1 year rate, okay? Do you understand what I'm saying? 10 years later, let me go back again. Like I say, it's drawing will be much better, okay? So what do you mean? 10 years later, if it is 10 years, so you imagine 10 years later, this 1 year rate, what the expectation RE is. But it's difficult, but that's a theory trying to tell you this logic. So all the short-term interest rate is others, is expectations built in and built up. That's how they can interpret why interest rate moving together, because they all in the same formula, right? You see, short-term rate, long-term rate in the same formula. All 1 year rate and N year N can be equal to 1, 2, 3, 4, 5. So A all in the formula. So that's why they're all moving together. And then why a little bit higher? Because you expected. Let's do this example, because you will see why your expectation is so important. Okay, let's do example. Write down the formula, and the formula is easy anyway. Let's go to the example. You will see yield curve. I want to show you yield curve inverted. Okay, let's do example. Okay, so let's say we observe it. So 1 year rate is 6%. We know. So 1 year rate is 6%. Okay. So I say you expected next year 1 year rate is 4%. Remember, expectation. This is E. Okay, expectation 1 year rate. Okay, E. So before you expect the interest going up. Now, if you expect the interest going down. Now, question is, what's this? The interest rate means 2 year. I have to do this. 2 years maturity, 1 year rate equal to what?
5.
Yeah, equal to 5. Yes. So equal to 5, equal to 6 plus 4. 4%. Okay, divide by 2 equal to 4, equal to 5. Did you see that interest is lower?
Yes, it's lower.
Exactly. Did you see interest based on what we learned? So inverted. Inverted, right? Before 6%, right now 5%. Because your expectation interest is lower. So you can see that's why short-term rate high and the long-term rate is lower. So that's inverted because the expectation there. So that's why this theory can interpret why yield curve upward, downward, and why yield curve moving together, because the formula is already tell you, because they link to each other, right? So because the long-term rate is derived from short-term rate. So of course they're all moving together.
Professor.
Go ahead.
In my other class, I learned that if there's a inverted interest rate, then usually there's a recession that follows.
Yes, that's what we just saw. Remember
usually
when you
indicator,
see?
Yeah.
Yes, you remember we just showing you, say, when you invert banking have trouble. Remember when banking have trouble, banking won't lend to you. If imagine you have trouble, do you lend money to somebody else? If you have financial trouble, you don't, right? Same thing in the banking. If no yield curve coming, they lose money. Why they lending money to you? They don't. So if they don't lending money, where we can borrow money to do business? You cannot borrow student loan. You cannot borrow restaurant loans. You cannot buy a house. You cannot do nothing. So when banking have suffering, economy gonna be interrupted. So that's called crunch, liquidity crunch, so many crunch, right? So that's because the yield curve inverted. It's not a good thing. Yield curve take a while, go back to normal, but yield curve inverted certainly hurting to economy because the banking is suffering. So that's exactly true. Okay, very good. So now we done this one. Okay, it's expectancy theory. So we're done, we're okay, right? So once we done that, so then tell you, this is like I just mentioned already. So this once we got this theory, we can explain about yield curve, why upward, why downward, okay, why moving together, because formula already showing you. Now we go to the next one. That's easy now, the rest of it easy, okay? Segmented market theory. So this is trying to say is, let me just go there. I'm just trying to say what? Trying to say, if the yield curve, that's a hypothetical, okay, upward, because people want, like you and me, most of us want to hold the short term. We all want to hold the short term one. Market demanding on short term. So if a market want the short term, I don't care what long term. I just want short term. You normal people, you and me, mainstream people, they remember you said risk aversion. They all prefer short term interest rate. So because demanding high in here, remember demanding high means buy the so many, then you buy price high, yield gonna low, right? Remember? So that's why low yield here, okay? Nothing else, just because this is segment, people demand, for example, let's say 10-year yield here lower, okay? Why? because the insurance company, everybody else, hedge fund for hypothetical, okay? They all want to invest on a 10-year treasury, not too long, not too short, 10-year. If that's the case, we all buy in this maturity, 10-year security. So the price will buy high, right? The price will going up over the 10-year maturity treasury. Then what happened to the yield? What happened to the yield?
Go down.
Going down, yes. So therefore, this yield curve will be lower. So how are you going to interpret it? You can't. Means the segment market just say you just people demanding, people want just this segment. People prefer certain big money manager just want to have to be somebody can affect market, okay? Like you and me, we can affect the lower end here, we preference whatever. But the insurance company, all that say banking, they all want this segment. They just prefer this segment. Nothing else they can say. So that's what the segment theory say. Say due to this particular segment, just they all want it, then they just want it. That's just why they buy the high up. If they don't want it, then yield will be higher. If they want it, yield will be lower. And that's what, because the price will high. So that's what the segment try to say. The segment relatively easy. Just what they are market wanted that segment stock bond that period of maturity. Okay, that's what they're trying to say. So segment is relatively easy. So bond of different maturities are not substituted at all, because they just want that one. Like I say, insurance company just want 10 years. Don't give me anything else. I don't want it. I just want 10 years because I have long-term liabilities. I have to have a long-term one. So I just want a 30 year. So then they just nothing you can substitute it for. I don't want to substitute it. My market preference that way. So that's what it is, okay? So interest rate for each bond with a different maturity is determined by demand for the bond, right? Just because they just prefer that, they just want that. That's the easy part, okay? So I just leave there for now. So that's segment theory. It means relatively easy. This is also easy. Just add on liquidity premium, okay? So that's relatively easy too. So what I mean liquidity preference, because you have, remember we said same name, but if long-term versus short-term, you just have liquidity concern. Let's say same GE bond, but a 5 year to 10 year will be different. And let me argue again. Okay, let's do the GE one. Okay, let's say GE. I both use the GE bond as a corporation. I don't want to use the treasury again. So that's a GE bond. GE offer you 5%. Okay, and a 5 year mature, 5 year. Okay, and they offer you 5 years percent and a 7 year mature. You will buy which one? You will buy which one?
The 7 out of the 5 year?
Yes, exactly. If GE offer this way, nobody will buy 7 year maturity, right? Who will buy 7 year maturity if you offer me 5 year maturity, give me 5% already? So nobody will go. So GE, in order to selling the 7 years, they have to give you attractive. Also 7 years longer than 5 years. So that's why. So they maybe give you 6%. So now people have to calculate which is a good deal or not. So therefore they have to give it high. So that's why normally it will be like this way, because the liquidity issue. Because long-term 5 years, who knows 7 years what happened? The sooner the better, right? So that's why the people will prefer. In this case, it's definitely 7 years too long than 5 years. And then give me same, so you have to give me different. And the compensation on that long-term, it is because you do not know what happened, liquidity issue there, okay? So, okay, so now we have this liquidity consideration, like here, just mentioned this long-term bond, okay? So now easy, when we do that, we just add, see, look, we have this, the expectation theory formula, and plus liquidity premium theory, just add on one more liquidity premium, okay? So just like I say, it's after this adjustment, then this yield curve will be considered about the Y upward or Y lower, because they have this add on liquidity premium, okay? So that's it. So that's the 3 theories So the last one is a pre-habit, okay? Just a preference, what do you prefer to do, but then not big deal at all. So investors have preference for bonds for one maturity over another. So somebody wants 3 months maturity, I just want a 3 months. But you and me are too small, we cannot move market. But normally it's big money maker or whatever, they're going to be preference to do this maturity because they have their own purpose, right? If they have, like I say, insurance have this preference way, pension fund have the way, so they have preference. That means you just prefer that's why interest rate can be that way. What I mean means this all those theory trying to say why interest rate yield curve can be upward, downward, or flat. Just trying to interpret, okay? So that's why you have preference, you have segments, you have expectation. All those theory trying to help you to interpret why interest rate like that way, okay, yield curve like that. So this yield curve, see, the yield curve if upward because they add on the liquidity, okay? So you may use expectations, but add on just upward a little bit because long term, like I said, the GE give example because one piece is longer than the other one, so that's why you give a compensation on the liquidity premium. So that's what is upward at the end. So that means this theory can interpret why interest rate normally is upward, okay? So you can see that interest rate use 3 theories give you interpretation, okay? Liquidity preference, so trying to tell you interest rate on different maturity bond move together, we know because of in the one formula. So that's what we talk, okay? And this also tell you that, upward, so that's, the liquidity also there tell you upward because add on. Okay, and then yield curve can be typically slope upward. So because you can see, like I said, add on the one liquidity premium, of course, typically will be upward. Means in normal healthy economic way, normal in general is upward. Okay, so, but however, I want to show you reality one. Okay, you see the truth. Okay, this is a fact. This is based on data. This one is 2011, okay? So this is upward, this is normal one, okay? You see, we do have an invert. See, look at the inverted. So 1981, okay? And this is relatively the flat, okay? So this is real yield curve, okay? So this to tell you, we were just a couple of years ago, we inverted, okay? We just right now, because the Fed keep make it zero. Now we right now just turn to normal, to the upward. You can looking at in Wall Street Journal market data, bond market, and when you open it, you will see the yield curve. You see the detail, they will have yield curve. Right now, we are looking like this right now, okay? So this is real world, okay? So here, we never have yield curves flat, the straight line, okay? Always a curve, okay? But they here just drawing the line, tell you could it be upward, could it be, this is steep, very steep upward, okay? There's a little bit upward and flat, but remember it's a curve, they never a straight line. But this give you example, so why yield curve can be anything, because we have 3 theory, try to interpret, it can be anything. Economy moving, our Fed adjust interest rate, make the curve moving all the times, okay, all the times. So this last slides. All right, so then we done this one. I hope, let me try to see whether I can open this yield curve for you, okay? If because normally I don't know why in the June I cannot open Wall Street Journal. Okay, let me see whether I can open that market data. All right, so I couldn't open the curve. So that's the thing, because when you have multi-system open, this yield curve very peaky. This cannot open up. Let me see. No, you cannot. Okay, but you guys, I want to show you where it is. You can do it, okay? Let me just show you where it is. Okay, did you see my screen?
Yes, Professor.
Yeah, okay. You see here's this one, okay? Look, when you look, open my screen didn't open up, okay? So the yield curve, you can see it in your computer, you can see the Wall Street Journal there, and you can see yield curve, they tell you previous year and current. You can see how our yield curve right now movement, okay? It's very good for you, okay? And then you should be able to see here's say 10-year notes. You see that one I hope I can show you, but I can't. My screen didn't pop up. So that's is 10-year notes during today or this week movement. That's not yield curve. It's the dot movement. Okay, so that's the whole point. Is you can see the difference. So you saw the other one is let's say this is 10-year yield, and that one curve is just showing this one how this movement. Okay, that's not curve. Curve is look at this. Each point here is one yield. Each point is one yield. So this is many maturity yields. It's a curve, but this is becoming like a rope, can move anywhere. But this one just one dot, one interest rate, the moving the pattern. Okay, so that's why you saw the difference. All right. So I done this chapter. Any question? Which one?
LIBOR, LIBOR, on the interest rate.
Where is the LIBOR?
I think it's LIBOR.
Yeah,
LIBOR.
LIBOR. Okay. Yeah, we talk about LIBOR. Remember, London bank offer rate. London bank offer rate, like it's a bank lending to each other in London, in Europe. Okay, so let's say global bank Barclays lending to UBS. Okay, they charge it as interest rate. So that's LIBOR, London bank
I
offer rate.
remember hearing they're gonna change it to something else.
Yes, they are. Yes, they're gonna change. Yes, they do. They are this because we still have product linked to LIBOR. All right, so therefore still have to be leave there. But now how they coding that is changed. So because in the past we have scandal because we have the people, different banks, and then they arbitrary offering certain rates. Just they didn't offer that. They just coded. The rule is that you haven't. Normally you're selling the product and then you charge it at a rate. That rate will be coming the interest rate we code on the market. But they didn't. They based on say, what do you expect your banking this times today will be lending of the interest rate? And they will say, oh, we expect to say 2% hypothetical, right? 2%. So at 11 a.m., they will post say JP Morgan over hypothetical say, okay, London Bank, right? So let's say UBS will offer 2%, and then the other one is let's say is Barclays will open 3% and divide by hypothetical 2 bank and then divide by 2, average out. Then this is the LIBOR rate. That's it. They published it. It's not really they trading it, selling it. They didn't. They just said anticipated because that they can do that way. So they becoming 2008 financial crisis moment. The trader just favor their own bank. They can say they just make the wrong numbers, not really the number they really expect to trade, but then try to favor to them borrow. For example, they want lower. They just say, oh, this much, or even they lending, they say, oh, that number. So make the arbitrary human made this interest rate and a scandal. This is scandal because they favor their own bank and they don't. So they become some guys get in trouble. And then later on, they say, okay, we don't want to do this LIBOR settlement this way anymore, coding this way anymore. So they want to change it, okay? They want to change it, do not coding that. But now it's they still have many people, they don't even want to use LIBOR anymore, but they still have people linked to LIBOR. LIBOR is very popular. It's a floating rate linked to LIBOR. Everything like in the past, we have ARM, remember just rate mortgage? Those is LIBOR plus was the spread. So all the people have the ARM, have the mortgage, floating rate mortgage, they all link to the LIBORs. So that's why LIBOR becoming still people use as a benchmark in there, still have the link there. So you cannot remove out, but they want to change how the method word and maybe change it also not called LIBOR, but many things they need to change it. Yeah. So that's LIBOR. Yeah. Any other question? All right, so let me mention about exam if we have time, right? How much time I have? Let me see. Okay, 1 minute. So the exam, like I said, okay, read a book, do the homework, and understand the slides, you will be okay. But if you don't read a book, you don't familiar your material, even you have book, you have anything, like trust me, you will panic, you don't have time to looking around, and then you definitely won't do well. no matter what happens, is you compete with your classmate. Somebody prepared, study hard. Somebody study because they like it. Somebody study because for the good score. Either way, you study, you will do well. You don't study, you think last minute can do something. Trust me, I will tell you, it's hurting you. Too late by then, you lower your score. You don't want that happen. So try to study that's the best for you. Even though it's online exam, don't think about it's easy, because like I said, random number, not random question, have time consuming, because we will all try to limit the time. Because you obviously you open book, open everything, it give you time. Of course, you all get an A. That's the whole point. We want to control the timing, make a constraint, less time, more question, overwhelming, and then see who's the study. That's all. Because you have too many resources, right? That's why. Okay, ask me a question.
Professor, are you gonna put any review questions up on Blackboard?
No, we don't have
No?
we don't do that. We review, we talk about the question, we talk about the exam, but we do not post the questions, because that like I say, if the question we posted, then that question will be never in the exam, and then nobody wanted it. Okay, what's the other question?
Is it enough to study of the slides for the exam, or do we need to study the book?
Well, yeah, in exam, no, the slides for me, it's not for you. Slides too simple, it's too short of information. So read a book is very important, okay? So slides is not enough. Homework is helpful, okay? And format, like I say, how the question look like. We'll talk more about that. Any other question? Sean, you have a question?
Yeah. Is there any additional practice besides the homeworks?
No, because you know what happened. This book, this material, like entertaining, enjoy that kind of material. So it's not harsh. Just read
Okay.
it. Yeah, to read it will be okay. Yeah. All right.
Okay. But if we generally do well on the online portion, the homeworks and whatnot, we should do well on the test, correct?
I hope so. Yeah, depends on your memory, depend on your reading.
Okay.
Yeah, but it's senior in general. If you're not senior, you're just working hard. Senior, like a certain concept you already know, because it's market, it's a Fed, it's
Mhm.
money supply. To them, relatively easier or familiar already. But for junior, you maybe just don't know. I don't even know what's mean market. So that means that'd be too difficult. That means you should read more. Then you can try to be understand. So working hard. If you know you are, junior, you should be working hard. Okay. So at this point, we say it's March 16. Okay, didn't change. Nobody have any issue so far. Then we just keep it 16. Okay. So far 16. I will make an announcement very soon. All right. So that's it. So we'll